Okay, let's dive into this. Welcome to today's Explainer, where we're tackling a really high-stakes topic for anyone doing business in Montreal right now. The city is experiencing this absolutely massive heavy equipment boom. But there's a serious catch. We're going to shine a spotlight on some hidden legal traps waiting for business owners, and honestly, the lenders who fund that growth too. If you handle your paperwork right under Quebec law, your asset is totally secure. But handle it wrong, you could literally face a total financial loss.
Here's our roadmap for the Explainer so you know exactly what we're covering. First, Montreal's equipment boom, then securing the capital. After that, we'll look at Quebec's leasing landscape, followed by the terrifying 15-day trap, and finally, protecting your assets. Section 1. Montreal's equipment boom, the need to scale. So, I've got a question for you. Is your Montreal business ready to scale? Because whether you operate in English or French, the city is offering some truly unparalleled opportunities right now. It's the vital logistics gateway for Eastern Canada, and businesses are scaling up fast. But to do that effectively, you need heavy-duty capital and, even more importantly, heavy-duty equipment.
And this brilliantly illustrates the sheer diversity of the local economy and where this demand is actually coming from. In logistics, you've got carriers running the Trans-Canada A40 corridor who desperately need commercial trucks and sleeper cabs. In manufacturing, it's all about aerospace, pharma, and advanced industrial machinery. Then you look at construction, where urban density is demanding high-value metro and infrastructure assets. And even Montreal's legendary hospitality scene is getting in on the action, constantly needing high-end commercial kitchen packages. It's really a massive, multi-sector boom.
Section 2. Securing the Capital. PMMTL Programs.
So how do you actually fund all of this? Well, the PME-MTL network tailors its financial levers perfectly. Now, what's really interesting here is the contrast between the programs. On one hand, you have the Phone PME-MTL, which offers massive variable term funding up to $300,000 for growing companies to acquire capital assets. But contrast that with the Crevenir program. Offered jointly with Desjardins, this is a highly targeted initiative specifically for young entrepreneurs under 35. It offers a line of credit up to $15,000 plus a $5,000 grant. They really do cover the entire spectrum of growth.
However, there is a catch. 20%. Whether you're applying for those major PME-MTL loans or targeting social economy subsidies, the entrepreneur must personally invest at least 20% of the total project cost. You absolutely have to have real skin in the game to unlock these municipal funding levers.
Section 3. Quebec's leasing landscape, the legal twist.
Securing that funding is super exciting, right? But once you actually buy the equipment, you suddenly step into the incredibly complex legal reality of the Quebec Civil Code. It's a reality that the financial services law group at Lavery literally dubbed a nightmare for businessmen and lawyers. The stakes here are just incredibly high. Some recent court decisions have turned equipment financing registration into an absolute minefield. So let's define the 3 legal structures you absolutely need to know.
First up is the installment sale. You can think of this as a standard term sale. The seller reserves the ownership, meaning they physically hold the title to the property until you have paid the sale price in full. This is by far the most common way businesses buy heavy machinery. Next is the leasing agreement, or crédit bail. This one introduces a third party. It's a 3-way business transaction involving a vendor who sells the equipment, a lessor who finances it, and a lessee, that's you, who uses it. The crucial detail here is that the seller is directly bound to the lessee for all warranties, and this exact arrangement must be clearly disclosed right in the deed of purchase. Finally, we have the ordinary lease, or bail ordinaire. This is a much simpler, 2-party agreement where the lessor just lets the lessee use the movable property for a fixed or indeterminate time in return for rent. Now, you might be wondering why we just defined all 3 of these? Well, it's because despite their structural differences, they all face the exact same, terrifying legal hurdle. Section 4. The 15-day trap, the legal ticking clock. According to some heavily debated rulings by the Quebec Court of Appeal, the reality is pretty harsh. Basically, failure to register your sale or lease within 15 days makes it, and I quote, ineffective against third parties. Now, impartially speaking, the courts have drawn a very hard line here. If you file late, you completely destroy your priority protection. So the crucial point is understanding this ruthlessly strict timeline. Step 1, you sign the contract. Step 2, you must register it at the Register of Personal and Movable Real Rights within that tiny 15-day window. And Step 3, deliver the equipment. Listen, you must never deliver the goods before registration. If you do, a secured creditor could easily swoop in, argue the transaction happened earlier, and boom, you lose your priority rank over your own equipment.
Now this turns into a complete nightmare if a business goes bankrupt. Under current case law, the bankruptcy trustee is legally treated as a third party. What does that mean? It means if you, the seller, register your contract even one single day late, the trustee can effectively ignore your claim. You are completely stripped of your rights to take back the goods, even though you technically still hold the title. It's a brutal technicality. I mean, imagine losing a multi-million-dollar excavator just because your paperwork was 24 hours late. But that is the law.
Section 5. Protecting your assets, legal safeguards. Let's move to and see how this builds into actual solutions for lessors and business owners who need to protect their investments.
So what happens if you actually miss that 15-day window? Well, you have two primary fixes, but they're definitely not created equal. You could try begging for a cession of priority from prior secured creditors, basically asking them to step aside. But the Quebec registrar actually refuses to officially register these. It's a massive high-risk gamble based purely on the good faith of the prior creditor. The much safer bet is a partial discharge, or voluntary reduction. This officially modifies the prior creditor's hypothec to exclude your specific equipment. And most importantly, it is 100% registrable. It's without a doubt the superior low-risk safeguard.
But the ultimate safeguard bypasses that stressful 15-day window entirely. Enter the master agreement. This is a one-time registration valid for 10 years that covers a universality of property, basically all equipment of the same kind moving between operating enterprises. If this is drafted and registered before the very first piece of equipment is ever delivered, it preserves your rights for a decade. No more tracking chaotic 15-day deadlines for every single tractor or commercial oven you finance. Which brings us to a final, pretty provocative question. Your equipment is funded, your business is scaling, but is your title actually secure? Securing capital in Montreal is really only half the battle. Surviving Quebec's unforgiving 15-day trap requires absolute precision. If you've recently financed equipment, this should absolutely leave you eager to go back and double-check exactly when your paperwork was signed, registered, and delivered. Because in Quebec, timing isn't just money, timing is ownership.